CD17.
All right, ladies and gentlemen, welcome back. We got May in the building. May 1st today. We got another chart talk coming at you. 1:14 here on the West Coast. That means it's 4:14 out east by Bennett. How are we doing today?
Doing good, my friend. No complaints.
No complaints. I got a lot of complaints, and it's about this market right here. We're dealing with some selling pressure, and the information we got the last 2 days kind of cements the fact that the bears are in control right now. We had a big Fed day, and we'll get into that in a bit. The results were, a big pop into a big sell-off. I'll talk about that in a little more detail in a sec. I think the big things about the Fed is now with inflation ticking back up, we saw a couple things. We saw a horrible GDP number, which is like, okay, that's kind of good in a rate cutting sense. It's like that could be an excuse to cut rates soon. Are you frozen? Oh, okay.
No, we're good.
We got the awful GDP number, and then we got inflation ticking up. We got employment costs ticking up 0.2% unexpected this month. It's just all the data is very conflicting, and it seems like inflation is persisting more than we thought it would, and that's the real trouble in the market. They can't cut rates until they see inflation go down, and then that's the next battle. So that every CPI, every PCE becomes super important again, similar how it did all of last year up until we really broke out in November, December. The inflation data didn't matter November, December, January, February, when the market's breaking out, the rates are down. Now rates are back up, inflation's ticking higher, and that becomes, we're in that very, very news-driven environment again. So I'm going to get into charts real quick. The main thing I want to, all right, so I got the Qs up. It's easier for me to look at the Qs than the SPY. I get a lot more information out of it. So I'm going to stick with the Qs for now. What we learned, all right, so we broke down a couple weeks ago, dramatic sell-off. We had that pop. It ended up, it's looking like a dead cat bounce so far. And then the last 2 days action is what really confirmed it. The difference I want to show you guys is the difference between bullish trends and bearish trends. So in bullish trends, they say never short a dull market. It's, we got into low volume sideways action. That's that's when you want to buy. That's, we're continuing the trend, stuff like that. In these bearish trends, they're looking for liquidity grabs. So there's just fake out moves left and right. And that's what we saw today. And that's what makes these environments so difficult, because of the added chop. You can be super bearish and easily lose money in these environments just because look at these whipsaw moves. But all this ended up being, this is today after the Fed. This is all a liquidity grab, so they can just slam it, and then everyone who bought this has to immediately sell, and it creates that downward pressure. So now we're in this little channel, and who knows what we get tomorrow. Here's a 15-minute chart of the last few days. If you're just a long swing trader and you don't really want to trade this mess, set an alert for 432 in the QQQ. And when we break this 434, 435 area, that's the time to get bullish again. Until we do that, we're going to be in the chop zone. So my recommendation, if you can't trade the chop, or you don't want to get too involved, or you're a swing trader or whatever it is, set an alert for in the Qs for 430. And when we're back above that area, it's gonna be swing time again. I anticipate that not to be for a month or so. Who knows? I don't know. But that's kind of my take, and I want everyone to recognize the differences between right now we're in a short-term bear trend. I don't want to do bear market, bull market, because these things are short-term. We're short-term traders. But just looking at the action, when things get difficult, everything's just a fake out move, a liquidity grab, just chopping around, trying to frustrate retail, day traders, all that stuff, so they can grab that liquidity and slam it, So definitely less is more right now. Something I've been going over my trades the last few weeks. Something I needed to do that I didn't do was be quicker to take some profit, not go for the home run as much, take those kicks and just be less greedy overall. That's kind of what I'm going to do these next couple months. It's a great scalping environment, really tough swing trading environment. So, you got to know your time frame and your approach in these environments. So that's really it for me. There's a few names we go over, but I'll send it back to you first.
All right. Yeah, give me a So it seems like we both had a very similar take on the overall market the past like week or two in the newsletters. We were kind of talking about like, kind of like the market itching over. Again, you talked about the Qs, and what I've been mentioning is like the Qs have been like first place. Like when the Qs are breaking out, S&P's breaking out, Dow 30's breaking out. Most major sectors are kind of following along with that. And when the Qs start to break down, we start to see that shift, slowly, pass through the other sectors. So just, obviously some when we see that risk off environment or when the market is selling off, you tend to see utilities break out, which is what we're continuing to see. Again, utilities is the most boring sector there is. So the breakouts are very de minimis, very tiny, but no shocker there. The other sector that's still holding up, surprisingly, is this telecom sector, just still in this, stage 2 breakout stage, hasn't really, one little, down day, big down day, but still within this overall, breakout stage. But we're starting to see, the staples, even the financials, most of the laggards to this breakdown have been like the financials, the energy consumer staple sector, where I'm trying to make this very visually easy to follow along. So we have this breakout stage in green, and then we have this topping pattern in orange, like almost like the light's turning red, but it's not red just yet. So we have like the staples and financials still in this like temporary pause, but we're seeing these lower highs got put in. Same with, I'm not going to pull financial because it's still the same chart, but we saw this lower high put in where we should expect to see that H lower. And that's what we're starting to see. Even like the, IWM, this nice little flag here, it met resistance, couldn't break above it, a little fake out move. It just seems like we need to break down lower. And that's what we're seeing in, energy sector was super strong a month ago. And we're just seeing support getting broken. We're seeing this in tech, support getting broken. We're seeing that in IBB. A few weeks ago, support was broken, and now it's turning, support is becoming resistance. Again, should expect to see a little price action. And same thing with the REIT. So we're seeing this kind of across the board where this is the first time this year that we've seen sectors breaking major support and turning that support into resistance very clearly, very textbook. So we just need to expect, like you mentioned, it's not going to be a bear market, but for the short term, we should expect to see lower price action that shouldn't come to, a big shocker to us.
Right. As far as we're concerned, like day trading wise, like day to day, it's like a bear market day to day, but it's not like we're not going to call it a bear. You know what I'm saying? Like,
Yeah.
I don't want people to be like, oh, it's a bear market, it's a bear market. So when we set up to the long side, it's going to be a rip and we're going to have a lot of great action swinging, but we're just not going to be in that for a little bit.
Yeah, I'm with you on that. Just while I'm here, I got a couple of charts to go over, and then I'll send it back to you. So we had this RDNT from the newsletter this past weekend. Surprisingly broke out today. Does have earnings coming up next, pretty much a week from today. So if you did get into it today through 50, we'd probably raise that stop versus 48. Just, keep aware you got about a week to get out of that one. This FitB, again, the financials, like we mentioned, the staples kind of holding up here compared to the other sectors. This little breakout today came right back. But just keeping on this 37 is a big base break area going back, almost to like mid 2022, this 37, 38 area. So, big base there. Some Dow 30 names. We got this Amgen, started to break out a little bit today through this base here. Seeing the same thing in this Home Depot. Not yet, hasn't got to that 340 level, but keep an eye on this. We have GTC, no good. RH, Restoration Hardware just bought a nice teak table from this past weekend, setting up for this 255 support buyback. Very tight little range down here. And we've seen in the past, this name definitely has had some significant breakouts through this 255. It really has woken up a couple of times. Again, I really like this Disney. I know Heaven's looking at it as a short, so not looking at this for a long just yet. But like you mentioned, keeping that alert set in the queues. Same with this. When this wants to turn back up to 115, I'll be involved in the short term. Heaven's taking a short down to this 110. I think it looks pretty good as well. So short watch list, but I'll send it back to you and you can go over anything you're keeping a close eye on.
Well, something I'm keeping the most eye on is the one thing we didn't touch on is the 10-year. So I kind of was sitting back and looking at this pattern, and it's just in this nasty uptrend in this channel. I was thinking, here's what I was thinking. I was like, this is kind of the same run we saw last time. We needed to break down. This is this is the run we're seeing, and then equities will lift again. You talked about the small caps looking like they have to move lower. You know, small caps are the most rate sensitive names. They need that access to cheap money. You know, and we're just flagging in the 10-year, and it looks like, you know, we're just about to make a dash to 5%. So as long as that's going on, it's going to be very difficult for stocks to rise. There's going to be the, you know, the few select ones, things like in big tech land, like Google, who has so much cash they don't, you know, they don't need they don't need access to cheap money and all that. But as far as, you know, the cheekier names go, they're not going to really be able to break out with rising rates, or, you know, in my view. So we need to see this break, but just the way the pattern's looking, it's looking like it's got to run to this 5%. And everything we heard from Powell today kind of makes me think that we're going to see these 5% rates. I'm not sure. I hope we don't. I'd love to see this breakdown before then. But, you know, the big concern, the reason they were saying, I was watching CNBC, we were talking about before this, guys, just how these guys are doofuses on TV. The reason we rose off in the beginning was, it was like, oh, Powell said there's not going to be any rate hikes. It's like, rate hikes, you know, those have been off the table for a bit. If he's mentioned rate hikes, that's
He's
bad.
like way out of the game. He's
Yeah. Like, that's a positive. We're not going to hike again. We're supposed to be talking about cuts. So that's why we got that action in the Qs that ended up just being all, you know, a liquidity grab. They're like, oh, we're not going to raise rates. So it's actually a dovish press conference. Like, what about that press conference is dovish? I digress. But yeah, so I was watching the 10-year today, and it literally just traded in lockstep with Nasdaq once that uh, once the press conference hit, you know, just rates looked like they were gonna puke, and, you know, during that same time, Qs looked like they were gonna rage. Qs sell off. Why do they sell off? Because the real move in rates didn't happen yet, and they got bought right up. So as long as rates are high, it's gonna be a tough environment. I'm still tracking the best names though. There's a lot of names moving really well on earnings. I'll go over a few of them. You know, there's TMDX, huge growth. I was very surprised with Pinterest gapping up. Pinterest is, since they broke this base here, they've been stage 2 uptrend, you know, and then they pull back over the course of the last 2 months. But these earnings get them right back in that you know, that stage 2 uptrend. I would like to see it flag out, let the moving averages catch up, blah blah blah. But you know, just as far as tracking names, I'm surprised to see some things up like this. This Powell had like insane earnings. Jay Powell, Powell Industries, you know, I don't know. WGS, sick growth, you know, huge 2-day move. This A10 was another one today. This Garmin. So I mean, there's Vita Coco. Vita Coco got a nice little pattern here. So I'm not looking to buy these things tomorrow. I'm tracking these names. I think we're going to be in this kind of very back and forth environment. And I think the most important thing for everyone to realize in these environments is how different they are from the bullish trends. In the bullish trends, we want to see sideways action, light volume in the broad market to indicate, you know, this trend is still intact and we're going to see it move higher. Here, you know, every time the market bounces, it could just be a liquidity grab like we saw today, so they can slam it harder. So every time you see the market uptick, I don't want people to be, oh, bottoms in, blah, 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 blah. It's like, we got to see a lot of stuff happen before we can confidently say a bottom's in. And I don't think it's going to happen for at least a few weeks. Maybe just in June. You know, Memorial Day is typically in an election year when we kind of turn up higher. We'll see if we're, you know, what we got. But wait and see mode. That's it. Wait and see mode. I'm going to be scalping a little bit, you know, when something looks juicy. This is not a home run environment at all. And you got to recognize that, or you're going to hurt yourself.
You mentioned Memorial Day weekend. We haven't done a trading experts meetup in a while.
Boy.
So I decided today to do a little Memorial Day weekend get together in my house in Jersey. So for all those that are in the New Jersey, New York area, I'll send you guys some individual texts. And for you members that are outside of the area, if you do want to come, more than welcome. I'll put it in next week's newsletter.
You got all thotties coming out?
Yeah, of course. I'm doing like an Italian theme. So I have I'm doing bartenders. Like for Halloween, I had some members over and I was just making drinks all the time. So this time when some bartenders come in, they're going to do all the work for me and I'll get to actually hang out a bit and relax. So
Bodies.
yeah, and definitely, yeah, that'll be a couple pretty ladies there in some nice dresses. I can promise you that. So
All right. Well, I think that's all we got for you guys today. Definitely more of a risk off time. Do less unless you're kind of scalping. Great environment for scalping. You just got to recognize, see both sides of the trade. Bears are in control right now. Every time you see the market uptick, doesn't mean the bottom's in. Don't get caught. So that's it. Other than that, the BS, like, subscribe, all that good stuff. All that good stuff that never happens. Like, subscribe, ask us questions. We're here for you guys. But other than that, catch you guys next week.
If you think you're going to get rich overnight trading, we're not for you. If you don't want to read daily or weekly to improve upon yourself, we're not for you. If you're not interested in saving weekly and building your accounts for the long term, we're not for you. If you're not looking to improve yourself daily, we're not for you. If you do want to build wealth for the long term, read weekly, save weekly, do all the right things for the long game, then we might be for you.